Hi, welcome to Market Minute. This is where we analyze the markets looking for opportunities, but most importantly, protecting our downside when we think we need to. I want to emphasize that point that I hate to lose money more than anything. Um, we have an aggressive approach, making money upside, but losing money, I just can't stand it. So when the market gets tough, we really focus on protecting the downside. This Wednesday, the Federal Reserve will have their meeting and come out with their meeting points. And they're not going to raise rates. They may raise rates in November, but not now. What's important about this meeting is the dot plot. The dot plot is when all the federal governors get together at this meeting and they put out their expectations for GDP, inflation, Fed funds rate this year, next year, and 2025. So we think what's going to happen is that currently the expectation last June was 5.6% on the Fed funds rate. That may stay the same. And then for a drop in 2024 down to 4.6. So 1% drop in the Fed funds rate in 2024. Sounds reasonable, right? And then the real GDP was expected to go up next year by 1% and inflation to fall to 2.5%. We think those expectations are wrong. Perhaps not the GDP expectation, but the inflation rate has been stickier than expected. So the Fed may have to raise those expectations on inflation and therefore not bring the 4.6% rate in 2024 on the Fed funds rate. So they may keep that higher for longer. What we think is happening is that there's a slow moving trend here of the economy deteriorating, and we'll go into a recession in some time in 2024 because interest rates are too high for too long. So anyhow, it's an important announcement on Wednesday of what the Fed's dot plots are, and look for perhaps an increase in the expectations of interest rates next year because inflation is staying higher than expected. Now below here is a chart that shows you the Fed funds futures and what they expect for next year. So 90% is in the band between 4% and 5% on the Fed funds rate. So roughly 4.5 is the middle, and that's where the expectation is of the Fed currently. So the market is on board with what the Fed said at the June meeting. However, that may change and the rates might go higher looking at the 2024 by the Fed. So we're watching the dot plots when they're reported on Wednesday afternoon. The balance sheet of the Fed has dropped considerably. It's down roughly 9%. So 9% drop in the balance sheet. That's big. That's a big contraction. And the market has followed it. Not in a real close pattern, but the S&P is down 7.4% from its high, and the balance sheet off 9%. That's a pretty high correlation. Also, money supply has contracted. It's down about 5%, although money supply increased significantly during the pandemic. 5% contraction. That's really negative for the markets. It's rather impressive that the market's holding up with the contraction in the money supply and the Federal Reserve bringing down their balance sheet and the federal funds rate going up so high. So although the market's off, it probably should be off more than what it currently is. Government shutdown. So what has to happen is for the federal agencies to spend money, they need Congress to approve it. So by October 1st, there are 12 appropriation bills that need to be passed by Congress. Obviously, the House is the one that's holding things up. It's political, right? Congress wants to bring, or the House wants to bring down the spending to the 2022 level, not keep it at 2023 or expand it. So there's some work that needs to be done here. It's a risk. We don't see it as a big market risk at this point, but it's political and it could turn into a market risk. So just keep that in mind. October 1st, this needs to be passed. Update on biotech. So I was in New York last week, 3 days of seeing biotechnology companies. So the major themes were Alzheimer's, NASH, obesity, inflammation. Inflammation's nasty, leads to all sorts of negative things. Cancer, of course, and rare diseases. So NASH is a very big market, and as well as obesity. Obesity is maybe the largest. There's a company called Viking Therapeutics, VKTX. We were buying the stock around in the $2 range last year, and the stock's done very well. It's 14 now. It was as high as 25. We think this is likely going to be bought out. I'm just guessing somewhere between 40 and $50 a share, but that's a total guess on my part, and I'd be very happy with that sort of return. But they have a NASH drug. It's in phase 2B, reduces the fat in the liver, median reduction of liver fat by 55%. That's extremely impressive and better than any of the drugs that we're aware of out there in the NASH space. Also, their obesity drug, 28 days on the drug. This is in phase 1. Now they're in phase 2. And they have an oral as well. They lost, the average was about a 8% weight loss in the first 28 days. That's far better than the Novo Nordisk drug that's currently on the market and what Lilly is potentially going to get approved. So we like Viking quite a bit. Checkpoint, obviously, a lot of you probably know the story because of me. Sorry about that. This company's got a great drug, cancer drug, immunotherapy. It'll likely be approved on or before January 3rd. The market cap of this company is only $40 million. Here's the problem. They ran out of cash. They thought they were going to sell the company just over a year ago. So they've been doing these offerings, these perpetual offerings to keep the company funded. So every time they do an offering, the stock falls and then it recoups. I think they're going to do another offering sometime during October or before October, but sometime probably before the end of October to do another stock offering to keep their trials going. But this company has 10x potential. Like Checkpoint a lot, they just got to get over this funding issue. And I sure wish somebody would come in and buy them out. It's a great value for somebody. Again, 10x potential in this stock, but they need to resolve their funding. Outlook Therapeutics. This is in the eye space. Shocked that they got a CRL letter, which basically puts the drug on hold. FDA didn't approve it. And there's some minor issues there. The efficacy of the drug was off the charts. It looked great. So we think they're going to work through it. Look at the chart on this, OTLK, okay? It's down less than 25 cents a share. We think there's 20x potential in this, or it's a zero. Could be a zero, but we don't think so. We think they're going to work through their issues. A lot of investors would like to put money in the stock at this point in time. So look for middle of October. They're going to come out with a press release stating what the FDA said they need to do to get approval. Now the whole space, the whole biotech space, starting two plus years ago, has been in a major bear market. Recently, the index is down about 16% from its recent high, and the Russell 2000, we think that's the reason for it, is down about 9%. So when small caps decline, these stocks tend to decline even more. Small cap biotech is not going to hold up as well as other sectors in that small cap space. However, when rates actually start to fall, probably the back half of 2024, we think there's a massive move in the sector. The fundamentals are really good. There's a lot of drugs up for approval. There's a lot going on in the clinical trials. The space is dirt cheap, so there's a lot of opportunity here. Take a couple year view or maybe a 10-year view. There's big returns to be made in the biotech space. I manage money in this area. I've got a special way I do it. I pick about 20 different small cap stocks that have big upside and it's performed very well historically. The technicals of the market, the S&P 500, they're weakening. So the market's gone through the 20-day, broke through the 50-day. Now the the 20-day moving average is pierced through the 50-day. That's never a good sign. And so we'll have to see what happens here, but it's losing momentum. It's a little concerning. We're being defensive. The 10-year Treasury, it's beyond the point where we're concerned about it. We get concerned about at about 4.25. Now it's 4.32, 4.50. We think the market breaks. It won't be able to support the valuations, and likely have a 10 to 15% sell-off if that would occur. So this is very concerning for us. Now, I mentioned last week that Oracle and Adobe will report. We thought that it would be disappointing because there's a lot of high expectations in those artificial intelligence stocks, and that's exactly what happened. They were disappointing. The stocks sold off fairly significantly, actually. So we think they're good companies. Oracle and Adobe, they're good companies, but we think that they were overvalued with expectations being too high. So it's put a little cloud over the tech space. Additionally, the semiconductors, Taiwan Semiconductor announced last Friday that they are cutting back their capacity expansion plans, and we think that generally means because of demand issues. That's why you do it. You don't do it for really any other big reason besides the demand not being there. So the semiconductor space is under pressure. It's broken again through the 20-day, the 50-day. It looks a little bit like the S&P 500. It's at a support level, needs to hold a support, and here's the 100-day. So it's a little bit weaker than the S&P 500 as we're so close to the 100-day. We think if it breaks that 100-day, you need to get out of the way of it, and technology will be under more pressure. So you can see back here where our algorithm had a positive signal on the semiconductor space, but breaking above the 200-day, and how the algorithm works. It looks for distance away from the 200-day moving average and starting to break the 20, 50, and 100-day. So if it breaks the 100-day, that's a major negative signal for that sector. And just remember, 40% of the S&P 500 is in technology. So if you have the tech group starting the weekend, you're likely going to get a pretty significant pullback in the S&P 500. Remember, watch the dot plots on Wednesday, how that impacts interest rates out to 2024, and also the 10-year Treasury yield. And remember, the Buckeyes are going to kick some Irish butt on Saturday. Take care.